What's up guys, AC here. Today we're gonna learn how to get to $1 million starting from zero. Even if you've never invested before, even if you feel like you're a complete beginner, don't worry, I got you. It's really not that hard actually. You just need to know a couple of things and give yourself plenty of time. Spoiler alert, 1 mil is just the beginning. We're gonna be crushing some insane numbers. So if this sounds good to you, let's get right into it. By the way, if you're new here, my name is AC. I'm a full-time doctor, a full-time entrepreneur, and a lifelong finance enthusiast. My goal is to help you get more comfortable with your money. Without further ado, let's get into it. What do we need to know to make $1 million? Let's go. All right, so the first thing you need to know about is something called an index fund, and more specifically, the S&P 500. So you've probably heard of individual stocks before, and if I mentioned things like Apple, Facebook, Amazon, or Tesla, you'd be able to tell me probably the ticker and what kind of company they are. But you probably haven't heard of something called the SPY. Now, an index fund is simply a collection of stocks. When you invest in an index fund, instead of investing in a single company, you're actually investing in a collection or a basket of stocks instead. The most well-known index fund is probably the S&P 500. The S&P 500 is actually comprised of the top 500 companies in the United States. The beauty of the S&P 500 is that there is automatic diversification and there's no choice you need to make. Whenever I talk to beginner investors, they always tell me, I want to start investing, but I'm not exactly sure which stock to buy. And in reality, I tell them, don't think about it, just buy the S&P 500. And this is because you get automatic diversification across all sectors. The S&P 500 has companies in tech, in pharmaceuticals, in financials, in real estate, in consumer goods, etc., etc. So it doesn't really matter that you don't know what these individual companies are, just know that you're invested across all sectors in the United States. In addition, the S&P 500 has a proven track record. In the entire existence of the stock market, if you look at any 30-year period of the S&P 500, it has always returned positive returns. And on average, it's returned 11% over the last 30 years. And actually, that's a pretty impressive amount. And when we do some calculations later, you'll see why that's more than enough to grow a steady portfolio. And by the way, if you're searching for the S&P 500, the ticker is SPY. A ticker is pretty much just a shorthand way to find stocks on the stock market. So for example, Apple goes by AAPL, Microsoft goes by MSFT, and the S&P 500 will go by SPY. The second thing you need to know about is an IRA. Now, an IRA stands for an individual retirement account. The most important feature of an IRA is the tax benefit. So when you invest in an IRA, you don't have to pay any taxes. Now, normally when you invest in a regular brokerage account, you're paying up to 20% in capital gains taxes. So even if you got that $0 investment to $1 million, you're gonna have a pretty hefty bill at the end of the day, and nobody wants that. There are two major types of IRAs you should know about, a Roth IRA and a traditional IRA. The main difference is the tax structure. So when you invest in a Roth IRA, you pay taxes up front in that first year, and then after that, you don't have to pay any more taxes. Whereas in a traditional IRA, you don't pay any taxes up front, but you end up paying taxes later on down the line. Now, for most beginner investors, I would recommend starting with a Roth IRA. This is because you're probably in a lower tax bracket at the beginning of your career, and so you want to pay those taxes up front. And there actually is a way to contribute to the Roth IRA even if your income is greater than $122,000. It's called a backdoor Roth IRA. It's not something you need to know about right now, but I just wanted to let you know that there's something out there for everybody. In addition, there is a contribution limit per year. So you can only invest up to $6,000 into a Roth IRA every year. I would encourage everyone to get as close to that $6,000 number as possible. It's really important to max out the Roth IRA early on in your career so you can give yourself maximal time for that money to grow. By the way, if you don't already have a Roth IRA, Fidelity and Vanguard are the two brokerages I would recommend to start. The reason I choose them is because they have low cost basis funds to invest in the S&P 500. In addition, they're beginner friendly and the layout is pretty easy to navigate. I started with Vanguard and I personally moved to Fidelity later on, but you can start with either. They're both the same. The third thing you need to know is something called the Rule of 72. This is when I personally had my class-shattering moment. After you learn about this, you'll never see time or money the same again. So we've talked a lot about investing and growth rates, but it's hard to conceptualize that. And so the Rule of 72 helps us out. It answers the question, how long will it take my money to double? Let's use the SPY as an example. Now before we mentioned that the SPY had an average return of 11%, let's just use 10% to make the math a little bit easier. So you take the number 72 and you divide it by 10, and then you'll get 7.2. This tells us that on average, your money will double every 7.2 years. So let's just take a hypothetical situation. Let's say you started investing at the age of 30 and you want to invest until retirement, which is the age of 65. That gives you 35 years for your money to grow. Now remember, your money is doubling every 7 years. That means your money is going to double 5 times. So whatever your initial investment is, it's going to grow 2 to the power of 5. It's hard to conceptualize this sometimes, and so I want to take a look at a graph to hammer home this point. All right, so here we go. I've pulled up an investment calculator and let's plug in some numbers. So let's assume you start investing at the age of 25 and you'll invest $6,000 every year until the age of 30. That means after 6 years, you'll have approximately 36 years as your starting amount. In addition, we're going to invest between years 30 and 65, which gives us 35 years for our money to grow. Let's assume a 10% annual return rate based on the SPY, and we're not going to contribute anything additional after the age of 30. So this will show us how much our initial investment between the ages of 25 and 30 will grow. So let's see. And there it is, $1 million. So that initial investment of $36,000 has turned into $1 million. Let's take a look at this graph to see what happens. So as you can see, your principal amount is $36,000 and it remains flat. This is because you didn't contribute anything additional after the age of 30. In addition, that green line is your total balance. And as you can see, the majority of your portfolio comes from the interest payments or the capital gains in the stock market. So between years 0 and 20, there is some growth. Your initial $36,000 turned into $250,000. And then between years 20 to 30, there was an exponential growth to approximately $600,000. And then in the last 5 years, it grew to $1 million. And this breakdown is just mind-boggling. So of that $1 million, 96% came from capital gains alone. And remember, I said that $1 million was just the beginning. So let's see what would happen if we continue to invest $6,000 every year. So here we go. Wow, $2.8 million. So if you started investing at the age of 25 and you continue to invest $6,000 every year, you'd have contributed a total of $210,000, and that would have grown to $2.8 million. And again, similar graph, similar breakdown. Of that $2.8 million, 91% is from capital gains alone. I hope this graph and breakdown highlight the importance of saving early. If you want to get these insane gains, you have to start early so you can let time and compound interest work in your favor. And that's it. That's all you need to know to save $1 million. So let's recap. Number 1, you need to open up a Roth IRA. I would recommend Fidelity or Vanguard. And number 2, the only investment you need to know about as a beginner investor is the S&P 500. And number 3, you need to give yourself as much time as possible for your money to compound. That's it. That's everything you need to know to be able to save and invest $1 million. The other question I've been getting a lot is, how do I invest in this bear market? In reality, that's actually the best time to invest as a beginner. If you want to learn more, check out this other video. Anyways, I hope I inspired some of you, and I hope you have a great day. See you next time.